If this is your first Rich in Conversation, this, as you know, is just something we like to add in extra. So I bring in pretty amazing people that I know, people who have achieved things in their life, people who help other people become successful as well, maybe, or there's just something really cool about them that I like. And I like to have them share a little bit about who they are, a bit of their journey, a bit of their expertise and their knowledge with you all as well. Ian says he thinks he's met you before, Sam, with Sarah Poynton, which is pretty cool.
Yeah, I know Sarah.
Yes, there we go. So
hi, Ian.
We've got lots of connections. Sam is a man who is very, very well connected indeed, knows lots and lots of people. So yes, so I'm not going to do an intro because I'm rubbish at introing other people. So I'm going to let you intro yourself, Sam, and just tell everybody a little bit about who you are and what you do.
Yeah, awesome. Thanks, mate. Appreciate it. And thanks for welcoming me on. It's cool just to have a nice time to chat because you're so busy all the time. You never get to chat anymore. I speak to Josh more than I speak to you, I think. But hi, everyone. My name's Sam. I run a company called Grand Union Finance. I have been in property finance since 2007, which for any of you that know your economic history was probably one of the worst times to get into finance. So I had a school of hard knocks first couple of years learning the trade. Eventually decided to do a little flip property project with my dad, which got me into learning a little bit about how we would finance those kinds of things. And I haven't really looked back from there. I've went very much from doing residential mortgage stuff into helping property investors and developers in the main. More recently, through starting Grand Union Finance nearly 6 years ago now, we've very much become development kind of oriented. So most of our clients are property developers. Lots of them are investors as well. But I do think there is a difference between the two and there is a bit of an overlap as well. And yeah, look, our philosophy is very much kind of going against the grain with our industry and how we do things. I like to think of myself as quite personable, where our industry can be quite corporate. No shirt and tie, as you can see. This is probably the smartest I've dressed in ages. I've got like a black jumper on rather than just like some band t-shirt. And we talk to people like human beings. I think we take a lot of time and care and attention in ensuring that they really understand what they're getting into. We analyze projects with them. We do a lot of modeling and all that kind of stuff. So take a lot of time to actually do that rather than seeing people as just a number, which I think is a bit of a mainstay in our industry, unfortunately. But yeah, just like we were saying off air, Lewis, I get a kick out of helping people. I really love the fact that over a long period of time, I've been able to help lots of people become successful and have those moments where you're on the phone to them and they realize, I've actually achieved some of the stuff that we were talking about years ago when we first started talking. That's an amazing thing to have a part in or a role in. So I guess that's, sort of me in a nutshell. But yeah, basically I'm a mortgage broker that likes to chat to people. Yeah.
And Sam is one of my go-to guys if I've got a question about what would this mortgage maybe look like? What would the rates be like about this type of product or blah, 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 blah. Going back to what you said there about helping people, I don't think a lot of people would necessarily think mortgage brokers are people that help people. So that's quite an interesting viewpoint I'd love to explore a little bit more. And again, going back to the conversation we're having just before offline to bring it online and in front of everybody, we were talking about property investing because a lot of us in Star Trading are people who have already invested in property. Maybe we sold the property dream and what that would look like, or are people who are looking to become property investors at some point in the not too distant future and use our trading profits to diversify. And I think we both have a similar opinion or the same opinion that it's really helpful. And this ties into the wanting to help people thing as well. It's really, for me, I think the best strategy for investing in property is to not see property as becoming your main income stream or replacing your job or anything like that. The best way to view property is a longer term play, a longer term investment where you already have a main thing. So for me, that was trading profits and using my trading profits to then diversify into property. That might be another business that you might have. It might be a job that you have, which is high paying, but you lower your expenses each month so you can reinvest that capital into property. But I kind of say the best way to invest in property is to have a high cash flowing vehicle like trading or a very well paid job or a business, or all three. Why not? Let's go for it. And then funnel all of that capital safely and correctly into property investments at that point. What do you think about that, Sam?
Mate, honestly, I could have just taken everything that you've just said and just plonked it into like one of my client calls that I have. Like I do a lot of like before we need to actually transact kind of strategy type calls with clients. And I talk about this all the time. Look, there are so many of those gurus out there that talk about, you know, you can become a millionaire with property. It's absolutely true. But they're all talking about like BRR, buy, refurbish, refinance type strategies where, yeah, you know what, go back 10 years and that was a great little strategy. It worked. It had its little moment in time where it was absolutely on it. You know, we said off air, didn't we? You could have got lucky and at a certain period of time bought a load of Bitcoin, and then 10 years later, guess what? That's not really, that's just the luck of the draw that you got into it at that sort of point in time. I think property as a vehicle it's a wealth grower, it's a wealth builder. It allows you certain freedoms because it is slightly more passive than like running a business, for example, because you can, in theory, get property managers to do this kind of stuff. But I think there's been this huge kind of, I'll take one step back on that. I was going to say there's been this huge sort of thing about everything's got to cash flow really well and all that kind of stuff. When actually the reality is, it's, as you quite rightly say, it's a place to dump some money to ensure that it doesn't lose value, and maybe it might gain some value and it might add an additional income stream to what you're already doing. And when I look back over the last 20 odd years, essentially doing this kind of thing, the clients that I've seen the quickest success on the property side with is when they have absolutely got exactly what you just said. And that's that other stream or multiple streams that feed into being able to find more money to then invest in that in the property projects. Because I think when you are somebody, and we help these people, at Grand Union Finance, we have a lot of these types of clients that are just wanting to be property people. And if you love property and it's what you do and it's what you bleed and it's what you think about when you go to sleep at night, awesome, do it. Like that, if that makes you happy, do it. But for a lot of people, it's just a conduit to take that next level in their wealth strategy, right? So if that's the case, having these other things that you can then dump into it takes away, it actually de-risks the entire thing. Because for a lot of people that we do work with where they're doing these kind of BRRs, or, the amount of people that come to us like, I need to leverage as high as possible, Sam, because I don't have the capital to deploy into this next project. We just last week got some terms out for a client that's buying 3 blocks of flats for in excess of like £1.5 million. And he's putting down literally a 10% deposit because of the way that we structured the finance. Sorry, £10,000 deposit, not 10%, £10,000 deposit.
I need to know more about
tiny
this.
Amount of money.
This is crazy.
Yeah. It's just because he's got a great deal and there's a bit of deferred payment with the vendor and all that kind of stuff. So these kind of like weird and wonderful structures, yeah, awesome, they can happen. But the reality of it is, and hopefully this client isn't watching, it wouldn't matter anyway because he doesn't know we're talking about it, is ultimately he said, if I need to put any more money into it, I can't do that deal. Now it's an amazing deal, but it would be even better if he had 20% to put down onto it, because the cost of funds is reduced, the risk is reduced, so he has put himself into a position which is relatively precarious to a degree. I mean, I've sense checked the exit and made sure that it's safe and all that kind of stuff, which is what we do. We want to make sure that we get clients out of the finance so we get them in as well. But ultimately, if he had more funds to deploy personally, the deal is better, and he would probably lose. I mean, the next couple of months, he ain't going to sleep a lot. He really isn't. And I know that. And I've told him that. I've been really open with him. I've known him for a long, long time. So I think when you have other things that can get you lumpy income, or even any kind of income that you can then save up and deploy into these assets that ultimately are physical, they're tangible things that have been built, or maybe they're something that you are going to build. And it's there. And somebody is then residing in them or inhabiting them if it's a commercial building. And they're paying you money every single month. So you're taking something where, and I still believe this is normal. Most business owners in the UK probably, because they're SMEs, they take the money, they spend them on holidays to wherever, and then the next month they start again from scratch. Whereas the intelligent investor, to coin to use a very good book, would take that money and not spend it all, and then put it into something that can then make them more money again. You know, it's rich dad, poor dad stuff, isn't it? So got 2 very good books into one paragraph there. That's
brilliant.
not bad.
Yeah.
And that's kind of how it works. There are variations of how that works, but if you look, I always say to people, if you look at most people that are listed on the Times Rich list, that is particularly the ones that are self-made, they're famous for the business that they own, but they're on the list for the real estate that they own, because that's what then builds up in the background and actually puts them on that list. You can have the top ones that are the billionaires, they're the outliers, you know, they're not going to be on the UK Times Rich list, but you know, the Jeff Bezoses of this world, they're the outliers. They've created something that didn't exist before. We're not trying to aim to be them, are we? We're just trying to aim to have the life that we
have
want.
The energy for that, yeah.
Well, precisely, yeah, absolutely. But I also probably couldn't lift anywhere near as much as that man can. He's like absolutely shredded now.
I know.
But you know what I mean? Like, those are the outliers. Those are the people that we all look up to and go, they're amazing. The Elon Musks, all these, yeah, great. You know, we're not going to be them. So in order to then be the best or be kind of probably what we want to do, we want to go on 3-4 holidays a year. We want a nice car. We want to be able to go out for dinner a couple of times a week. You don't have to reinvent the wheel to do that. You just follow the path well trodden, which is well trodden for a reason. And that is basically it. Find something that you can make money with, use that money to buy something that continues to make you money and raise in value. Happy days, right? And I've made that sound very easy, but it is.
Well, there definitely is a certain simplicity, particularly when it comes to property investing, because it is just a numbers situation. Do these numbers stack up to make this a worthwhile investment? Yes or no? And yes, the problem that I found with property is sometimes those figures, you don't know what they're going to be until it's too late, unfortunately, or you get a dodgy builder, you get dodgy this. There is other risks involved as well. But if the numbers work out, it works out. Sam, tell us, what would you say are some of the big mistakes that people starting out in property, or maybe the biggest misconceptions or misunderstandings that they make or have when they're beginning a property investing journey?
Yeah, this is funny enough. I reckon this is probably a question I get asked like the most, which is I think there are 2 real key things. I think the time horizon is always wrong. Exactly what you've said. There's that phrase, isn't there? People overestimate what they can do in a year and underestimate what they can do in 10. Just think this is a 10-year project plus that you're getting yourself into, and don't think that, you know, there are people out there that have probably quit their jobs in 3 months or whatever through doing property, but that most people won't. So that time horizon needs to be realistic. And I think the other side is that people are just over optimistic, particularly when it comes to figures. The best investors out there will be the ones that actually downplay the figures, make sure the deal still stacks, and then get to be happy at the end when it comes out better than they thought. I had a client recently where she bought a property as her first ever it was an HMO conversion. They had their own home and they had a property that they'd rented out as a buy-to-let, her and her husband, but they'd never done this before, and they bought this HMO property at auction, and they did all the work themselves, and then at the back end they wanted to try and get a commercial valuation on it, which we managed to do all of that, and the valuation at the back end came in like 70-80 grand higher than what we thought it was going to come in at. Because we worked out on a bricks and mortar to start with, and the whole deal still stacked on that. So I think it's when you have a range, like you said, it's really difficult to determine some of these figures, but you can usually determine a range, and you can look at a worst case scenario, and you can stress test everything. If we're looking at a development style project where someone's buying something, there's works to be done, and then we're looking at gross development value on the back end, we'll look at right, okay, the works, is that how much it's going to cost you? Or if we went out to open market tender, is that what it would cost? Have we added in a 10%, a 15%, maybe even a 20% contingency on the costs? How have we worked out a contingency on the time frame? GDV, we've got this range. Does the deal work at the very, 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 very bottom end of the range? If all of those things still stack, awesome, right? That's a deal. That is then a deal. And you can go into that feeling very confident that even if the worst should happen, it's probably going to be okay. And I think too many people, unfortunately, go into deals and they look at the top end of the range. They might speak to an estate agent who's ultimately trying to sell their services to them by giving them a really high figure. So you have to think about why people are giving you certain figures. I would say surveyors are looking at the work downside risk. The agents are trying to sell you the upside risk. So always have a look at the difference between those two. And yeah, they then ultimately get disappointed. And I think the thing I see a lot is people coming and saying, I've been searching for a deal for 6 months, 9 months, 12 months, and I finally found this. And I'm like, but that isn't good enough. Don't just because you've been looking for something for ages. I mean, number one, you're probably looking in the wrong place if you're looking for 12 months and you haven't found something decent. But don't just go for a deal because I'm like, oh, I'm tired of looking, so we'll just do this deal. Like,
it's so funny because there's such parallels there with people and their trading. So when people get the seal of approval with us, which is basically us saying, yes, you can trade the markets live now, we think you are accurately, correctly, safely using the strategy. What tends to happen when they first get it is they kind of forget everything that we've just taught them. Hello, Kavita, good to see you. They kind of forget, and then they just want to take a trade because they're like, well, I can trade now. I've got my seal of approval. I'll just take anything that's moving. And there's a process there of learning like, okay, no, be patient. Only take what we actually see there as well. So I'm loving the parallels there too. There is a question come through. Remember, everybody, you can ask questions, but I'm going to ask a question beforehand. Just I'd be really interested. What would you say is kind of the state of the mortgage market in general at the moment, with everything that's going on in the world? What impact are you seeing that having? Do you have any view on when you think that may change? Why we're seeing this behavior from lenders as well, where they're pulling rates or they're changing rates like overnight? I know some mortgage brokers are looking at 3xing their stress testing and things like that as well. What's your kind of take on what's going on at the moment? And maybe just give people who are maybe not so involved in property, because this will affect everybody, by the way, if you have a house or you live in a house or you rent, because it's going to impact everything. What's your kind of summary of what's going on at the moment and your take on what's going on at the moment?
Yeah, that's right. Sorry, I've got to keep this short because I could go on this for years. Look, there's something going on in the Middle East at the moment. If you haven't looked at your TV recently, it might be worth it. Even if it's just for the quips that Donald Trump's coming up with at the moment to entertain you over dinner. But as a result, it's creating a supply chain issue when it comes to oil. Oil is probably the world's most sought after commodity, and as a result, it's having a massive impact on every single country's kind of economic outlook. It's had a very quick because, of course, as we know, Donald Trump surprised everyone with it. Made some little messages about that recently. That was funny. But he surprised everyone with this in what we didn't know. And I think surprise and shock are things that the economic markets do not like. When it comes to lending, a lot of lenders, particularly in the mortgage side of things, don't actually lend their own money. They lend other people's money. And as a result, there are background systems in place to determine kind of what the charges should be for big JP Morgan type institutions at the top that are filtering this money into the market. Like, how much will it cost this bank here to borrow from that bank up there? And these are called swap rates or SONIA rates. And essentially, the more they fluctuate, so the more disturbances there are to financial markets, the harder it is for bank B down here, who's borrowing from bank A up there, to determine what that cost is likely to be. If it gets too volatile, that's when they would potentially just pull rates temporarily and go, let's just see where everything lies over the next day or so. Let the dust settle, so to speak. And some will just go, right, we're just going to have to increase our rates to incorporate that volatility. One thing that a lot of people don't know about just borrowing money in general, because this can be the same when buying your own home and that sort of stuff, is mortgage lenders don't actually, the cost of the money that they're lending to you, if they are borrowing from somebody else, isn't solidified until they actually lend it to you a lot of the time. So if you think that the average transaction in terms of purchasing a home for yourself in the UK at the moment is probably like 4 to 6 months. These lenders have got to determine in 6 months' time what the cost of that finance is going to be. And that's why a lot of the time lending can be substantially more than maybe what the base rate would be. So that's kind of the reasons why recently we've had a lot of volatility in the mortgage market. But as I say all the time, it's one of my little phrases I like to use, that interest rates are temporary, the deal is permanent. The purchase price is permanent. So when you're looking at these kind of deals, I wouldn't not do deals because you don't want to be spending X amount on, or you don't like the idea of spending a lot of money on funds for that project. Ultimately, if the deal still works and the cost of the funds have gone up and the deal still works really, really well, it's still a deal. Yeah. So don't be put off and don't sort of not do that. And I think we're seeing that at the moment. We're seeing that the market, the property market in the UK has certainly taken a hit so far this year. I definitely have been seeing property. I mean, I live up in the West Midlands, and I'm definitely seeing property prices go down in our area. But that represents such an amazing opportunity for investors, because funds are still available, particularly if you're looking at property projects like a lot of our clients are looking for. They're looking for something to convert into something else, a block of flats to convert, an office block to convert into flats, some land to build houses on, a family home to convert into an HMO, something like that. Those opportunities are massive, because you're still adding this value. So I think the economic outlook is not amazing especially in the UK. I'm not political in terms of I'm a staunch conservative supporter or whatever. I just want a government that's best for what I think is best for the UK, and also selfishly what's going to be best for me personally as a business owner. And the people that are in charge right now, I don't think are doing the best for both, which frustrates me. As we said off air, it's just upsetting a little bit, I think, more than anything else. So, but we still have a strong enough economy, and the UK is still a strong enough country and has enough opportunity to be able to break out of whatever is going on. And still become a success for yourself. Or you could do what Lewis does and actually break away and just go and live in another country. But yeah, I think the economy is the economy, and what we're told is probably actually very far from the truth a lot of the time anyway. For me, it's always about just seeking out the opportunities and taking the responsibility into your own hands to do what's best for you, right?
Yeah, big time. So questions come through here from Mandy. So what's your take on using your existing pension as SIPP or SAS investment? And what would be the lowest amount to make it worth it? And then another tag-on question, or starting a syndicate pot to do one of these strategies?
Yeah, so look, I'm not a pension advisor, so I can't anything I say is advice with a small a, not a big A. But look, we've got loads of clients that we work with that use their SAS to invest in property. Obviously, as we know, the traditionally SAS funds have to be used to purchase commercial property. Now, I don't necessarily think that's a bad thing, because commercial property right now is an awesome thing to get involved with. I think with everything that's going on with the Renters Reform Bill and all that kind of stuff that's in the news a lot at the moment, with residential investment property, actually investing in commercial is no bad thing. We have a lot more rights as commercial investors than landlords do, and there's a lot of money to be made in those kind of industries, particularly I think at the moment taking larger commercial blocks and kind of cutting them into smaller units. I think that sort of call it CMO, commercial. I can't remember what CMO stands for now, but basically cutting up bigger commercial properties into smaller ones, and you can use SAS funds for that, absolutely, and lending to coordinate alongside that. The lenders that lend commercial finance are much more au fait to understanding the origin of the funds when it comes to these kind of SAS pension schemes. However, there are kind of like little loopholes that can be used where you can still use this type of pension. And you have to be a bit careful. There are still some lenders that are like, I'm not too sure about this. There's that a grey area type thing. So it's always best to speak to a broker, obviously, when it comes to this kind of stuff. But if you're using funds from a SAS to invest into, for business purposes, which obviously what it is, into a limited company, that money can potentially then be used to put down on residential property if needs be. We just need to have a clear line of sight to get those funds back within a certain period of time. But it can be very tax efficient. Obviously, it's a great way of actually being able to build your pension pot as well. And I think that there is enough. That's it. Commercial multiple occupancy. Thank you, Ian. I just had one of those moments where my brain just wasn't working. So yeah, I think that it's a very, very good way of investing funds, basically. And the second part to that, in terms of sort of syndicate pots. Now, I think what and if they want to confirm to me whether I've got this right or not, I think what we're talking about there is kind of like the old style, like mortgage club type things. Mortgage lenders don't really, if that's what we're talking about, mortgage lenders don't really like them. They would prefer, much more standardized special purpose vehicle type limited company structures with directors and shareholders, even if there's another layer above where we've got big like group structures as part of it. So I'm literally this morning, the last thing I did before jumping on with you, Lewis, was walking things through one of my team, Nikita, who does all of our commercial case management. We've got a client. There's four ultimate beneficiary owners, but they all own their own companies, which own shares in a company that owns this SPV. So we're trying to like put this whole group structure together to get it to a lender so they can understand ultimately who's going to be signing all those PGs and all that kind of stuff. But that might sound really convoluted, but it's something that lenders can get their heads around. Whereas these kind of property club type things where everyone's sort of dumping money in, lenders aren't as keen on, if I'm honest with you. If I've got that wrong, by the way, then please correct me. And if that's not what you're getting at all, I'm more than happy for you to confirm that and I can answer it properly.
Yes, so Mandy said, so meaning multiple people joining their pensions to gain a large pot for the one commercial investment.
Oh, I see what you're saying. Okay. I've not, if I'm honest with you, I've not come across it before where I've had to work on that as a live deal. So I'd be learning with you, Mandy. But if it's something that you're looking at and you want to have a chat about it, I can, and we can. I think to give a bit of context, I always say to people, it's when I did 2 history degrees. Don't ask me why, I did. So when I go and do a pub quiz, if a history question comes up, all my friends are like, "Oh, you should know this, Sam." Well, history is everything that's ever happened up until now in the world. You can't learn everything, but what I learned through doing those degrees was how to access the information quicker, to formulate it and be able to pop it out the other end in a way that makes sense. Being a mortgage broker / finance broker actually is really similar insofar as I might not have the absolute single answer to that, Mandy, but I have access to the people that do in terms of the lenders. I can pull that information very, very quickly and I can pop it out the other side in a way that makes sense. And we can have actually a human being conversation rather than a mortgage speak conversation about. So happy to have that conversation to see whether that's possible or not.
Yeah, amazing. So Kavita says, can you also talk about the landlord tax caps being introduced for income threshold being reduced for tax software?
Let me go up and have a read of that question myself. Can you talk about the landlord tax caps being introduced for landlord? Is this to do with the renters reform bill that's coming in? Is that
yes.
Is that what? Yeah. I mean, from what I can gather about the whole bill itself, and again, I have to be really, really careful because I haven't read through the whole thing properly. I'm just I speak to loads of a lot of my clients that are like your proper old school landlords are big into this, and then they'll relay information to me. So I'm only going kind of on secondhand information a lot of the time on this sort of thing. But I think initially it looked really not that bad for landlords. It didn't seem like it was going to cause too many problems. And now, as things have progressed, people are picking apart and going, well, actually, in real life, this is going to mean this, and this is going to mean this, and this is going to mean this. And actually, it hasn't been as good. I think that with anything to do with any changes in legislation, the thing to do is everything's going to be bespoke to your own situation. So for one person, it's going to affect you less than it might do for somebody else. Anything to do with tax, you have to speak to somebody that properly knows tax. I think the UK, the tax charter or whatever you call it, is longer than, somebody said it was longer than 24 War and Pieces back to back or something. It's one of the biggest documents in the world. So I think even if you chucked it into ChatGPT, it would struggle.
Yeah.
So for that kind of stuff, you've always got to go to the person that has the knowledge of that specific thing and how that's going to be relevant to you. Otherwise, it's just generic and it could be misplaced.
Yeah. So final question. just 'cause I'm conscious of time, what is one piece of advice you would give to somebody looking to go into property, or to somebody that is already in property and doesn't know what to do next?
You've got to reverse engineer. You've got to look at actually what you're trying to achieve long term. Because I think what happens is a lot of it is bottom up thinking, and it should be the complete opposite way around. The amount of people I speak to, and they're really shocked when it's the first time I've spoken to them and I say, why are you doing this? What's the goal? What does your property business look like when it's done? And what's the purpose of it being that way? And they can't answer those questions. And I think taking the additional time, this is going to sound really lame, but getting a notepad and a pen and going to Costa, other coffee shops are available, and sitting on your own and actually thinking about your life. What do you actually want to do? Because the amount of times, number one, the amount of times I go, what are you trying to achieve? And they'll go, I want 10 grand a month. Oh, great. If I had £1,
it's just the go-to number, isn't it?
I'd have 10 grand. Yeah. It's just too generic. It's too, go and actually map out what you want to do with your life. Because people get shiny penny syndrome. They'll go onto Instagram, they'll see somebody making loads of money in HMOs, and they're like, oh my God, that's the thing I need to do. I need to go and build this portfolio of HMOs. And then they build this portfolio of HMOs, and then they have anxiety every second of every day because it's such a time intensive strategy. Whereas actually, if they'd taken a step back and said, do you know what I want to do? I want to quit my job and I want to be able to go on a holiday a month for the rest of my life. That's a completely different thing that you're trying to achieve. You're trying to find the most passive way reduce the number of hours that you need to work on something while still gaining more money than you currently have. Okay, what is the strategy that's going to allow me to do that? And by the way, this is another thing. People, what you start off with might not be what you actually end up with. Everything is a stepping stone. So I'll give you a great example. Before Christmas, I was sitting with the missus. She's an accidental landlord. She's got a property that she lived in many, many years ago, obviously having issues now because of everything changing when it comes to personally owned rental properties. And we were discussing like, where's this going to go? And we used a bit of ChatGPT to brainstorm and things like that. And we actually came up with a 10-year strategy for her. And it was in 3 chunks, essentially, with the final chunk being that she had a portfolio of properties that were relatively passive, and would mean that she would be able to have X amount per month or X amount per year with probably working 3 or 4 hours a week, But that wasn't what we did first, and it wasn't what we did second. Firstly, it was like, right, we need to generate money. How do we generate money? Well, we have to buy and sell something. So then we have like a bit of a flip strategy to start with, which generates the funds that then allows us to start moving into section 2, which is that we need a high cash flow strategy. So SA or HMOs or something like that to continue to grow that and keep it self-generating to grow and grow and grow. And then we have the last bit, which we switch over these blocks or these properties into something much more passive, leasing them to companies, social housing providers, this kind of stuff. So it was clear that how it ended up is not how it started. And I think a lot of people, they go, I want to be an HMO property investor. Great. Well, where does that fit into your big strategy? And I think that's the key thing for me, mate, is actually starting with the end in mind, taking the time to think, what are you doing? You and I guarantee you, I've had this, I know you've had it without you even asking you. You have those moments where you're so busy and you take a step back and go, what am I doing?
Yeah.
Actually, why am I haven't had a thought to myself for a week. This is not what I signed up for. This is not what I wanted. And they're the moments that we have to, as business owners, take a step back and go, I've got to reassess this. I've got to figure this out because this is not what I signed up for. This is not the trajectory that I wanted to be going on. And
I think one thing you just said there is business owners. But one thing I would add on to that is yes, we need to do that as business owners, but your life is your business, right? Mm-hmm. So if you have your own life, you have your own business, your personal economy, your personal economics, that is a business. It's just under a different word. It's called your life. So anybody who's got a life needs to be thinking that way as well. Final question here from Kavita, which you may or may not be able to answer. Are you better off transferring money to the company bank account for a purchase of a buy-to-let, or transfer from personal account to the purchase?
If you're buying in a limited company, the limited company has to buy the property. So you've got to transfer the money into your company, and that would be via like a director's loan. Again, get some tax advice on this, Kavita, because depending on your personal circumstances, they might do it in a very, very slightly different way. But the good thing about that, and I saw a video that somebody else was talking about this recently, which is that money that goes in, by the way, you can get that back out tax-free, by the way. So if you put 50 grand into a property company, you buy that property with, you know, the first 50 grand of income that you want to take from that property business is essentially tax-free. So absolutely, Chris has mentioned this, because that is actually, funny enough, on the video that I'm talking about, which I can't even remember the guy, my comment was, and you can actually charge interest for that too. So yeah, absolutely. So whatever the entity that you're buying the property in, that's the account that needs to transfer, because you're going to ultimately transfer the money to your solicitor, who's going to do it all. But that money has to go via the limited company if it's going to be a company purchase. I'm sure there are some loopholes around that, but you've also got to look, if there's loopholes, you know, why a lot of the
Why
time
not use them? Exactly.
It's not the way. It's
I feel like the word
the right way.
Yeah, loophole feels like it's a dirty word to some people, but it's actually just efficiency. Like there's efficiencies that you can use. Why would you not use them? It doesn't make any sense to me.
And sometimes actually it's the long way around. I'm going to bastardize this quote, but it's from a teen movie back in 1999, I think it is. And someone was asking about. Someone said that going a shortcut was there was basically some danger and some risk by going the shortcut, and the guy said, of course there's danger and risk in taking a shortcut. If there wasn't, it would just be the way.
Yeah.
And that was from Road Trip. That's very well known, theologically, you know, incredible film. But it was such a good quote. I've used it so often because it's so true.
Well, Sam, thank you very much for joining us today. What is the best way that people can connect with you? I've shared your Instagram there. Is there maybe an email address or something as well that people, or a website that people can find you on?
Yeah, we're kind of updating our website at the moment, so maybe not the best place to go, but if you want to come follow me on Instagram, send me a DM. I reply to every single one of them. Give me day and a half or so, and generally I will. You might even just get a quick voice note back from me if it's answering a question, or if you don't want to go down that route and you want to contact me directly, my email address is really simple. It's sam@grandunion.finance. That's it. Google hates that email address, but yeah, thanks guys. I really appreciate it, and hopefully I've been of some use.
Been brilliant, Sam. Thank you very much. Thank you everybody for joining us as well, and I will speak to everybody very, very soon. Bye bye, everyone.